Silver is flashing scarcity again, and the paper market is trying to price it like nothing changed. Not because the move isn't real, because acknowledging it forces everyone to admit where the pressure is actually coming from. And the hidden detail most people miss isn't to some headline or rumor. It's the way the physical premium is refusing to cool off, while the paper quote keeps pretending the market is liquid. That divergence is the tell, and if you know how to read it, you'll know what matters this week, what level decides the next 2 weeks, and what breaks first if silver tries to push again. Right now, you'd have got a silver market that looks calm if you only stare at a chart for 10 seconds and looks borderline stressed if you try to replace metal in the real world. That's the conflict. One world is deep and fast and levered, futures, options, paper hedges, algorithms, margin. The other world is slow and sticky and physical, blanks, fabrication, shipping, wholesale availability, dealer inventory, industrial procurement. When those two worlds agree, silver feels boring. When they split, silver becomes a problem you can't hand wave away. And that's where the real pressure starts. Let's get grounded in what right now actually means. This month has been violent. You'd have seen silver jump from the low 70s early in January to prints north of $90 mid-month, then whip back into the mid to high 80s, sometimes in what feels like a single breath. You can see the same story in different arenas. In India, silver futures pushing through the RS3 lakh per kilogram milestone for the first time. And in the US futures chain, contracts in that upper 80s neighborhood after a sharp burst. The exact number you see depends on the contract month and the moment you check it, and that's the point. This is a volatility regime, not a sleepy grind. And in a volatility regime, the paper price can be technically correct and still be economically misleading. Because the replacement cost, the price you pay to actually get specific forms of silver delivered to you, can behave like a different market entirely. But that's not the part that matters. The part that matters is what rising premiums are really telling you. Most people hear premium and they think it's just a dealer markup, like paying extra for convenience. Sometimes it is. But when premiums rise while paper lags, that's the market whispering that the easy metal is gone. Not gone as in conspiracy, gone as in allocated, spoken for, slow to replace, trapped behind lead times and bottlenecks. Premium is the stress gauge. Premium is the friction in the system. Premium is the price discovery that happens when real-world constraints are louder than screen-based liquidity. And when that spread between physical and paper widens, it forces uncomfortable decisions on everyone involved. Dealers, fabricators, industrial buyers, and yes, the paper traders, who suddenly realize their hedge isn't as clean as they thought. Because if this one level breaks, the math changes. Here is the hidden detail that reframes the whole story. The market OS lie detector is the spread, not the spot quote. When you see spot or front-month futures whipping around and headlines screaming silver up or silver down, your brain wants to make it a simple story, but silver is never a simple story when it's stressed. The real signal lives in the plumbing, the relationship between near-term and later-dated pricing, the urgency embedded in the front end, and the cost of carrying risk through time. In normal conditions, the market pays you to wait. In stressed conditions, the market starts bidding for now. Even without perfect data in your hands every minute, you can feel this through symptoms: premiums rising, availability tightening, shipping windows getting slippery, and risk controls on exchanges changing the behavior of paper participants. And that's where the mainstream narrative tends to fail, because the mainstream narrative wants one price, one story, one neat label. Silver is giving you two. The next detail is what flips the whole setup. The why now isn't mystical, it's the calendar. Late January is a classic zone where liquidity thins, month-end flows start to matter, and desks begin to think in terms of reporting windows and risk limits. On top of that, precious metals just got a new kind of stress amplifier, the exchange risk framework itself. The CME has moved precious metals margins toward a percentage of contract value method, which sounds boring until you realize what it does in a fast-rising market. It turns margin into an automatic ratchet. Price goes up, required collateral goes up. That's not a moral statement, that's mechanics. It means as silver rises, it becomes more expensive to stay levered in either direction, and the weakest hands, whoever is most overextended, get forced to act. Forced action is what turns a move into a squeeze, or turns a squeeze into a crash. Same system, two outcomes. And that art is why the calendar matters. Because when volatility collides with margin rules near a reporting window, behavior changes faster than narratives. But that's not the part that matters either. What matters is what paper lags actually means. People toss that phrase around like it's proof of suppression or proof of some grand scheme. You don't need any of that. Paper can lag for three perfectly normal reasons that still create explosive outcomes. First, liquidity. When the book is thin and volatility is high, fewer participants want to, quote, tight markets, so price discovery becomes jumpy and reactive. Second, risk constraints. When margins ratchet up, funds reduce exposure, market makers widen, and short-term traders become allergic to holding risk overnight. Third, hedging pressure. In a rising market, dealers and producers and funds are constantly adjusting hedges, and that hedging can delay or distort the headline move even as it intensifies the pressure underneath. None of this requires villains. It requires incentives. And incentives create patterns, and those patterns are readable. That's where the real pressure starts. Now bring it back to the street-level symptom, premiums. If you're watching popular retail products, 1-ounce coins, small bars, the stuff ordinary buyers actually transact in, but you've seen the language that matters. As low as X over spot, limited allocation, pre-order, expected ship date, pricing subject to change. Those are not marketing lines in a stress moment. Those are operational admissions. They're telling you the dealer is managing inventory risk in real time. Fabrication isn't a faucet you turn on. It's blanks, presses, staffing, quality control, packaging, shipping, insurance. When the system gets hit with a wave of demand and a wave of volatility at the same time, the physical chain doesn't respond like a futures contract. It responds like a supply chain, unevenly, with delays, with premiums, with rationing by price. And that's where the real pressure starts. Here is the paradox that trips up smart people. You can see selling in one corner of the physical market and still have tightness underneath. You'll hear things like junk silver is soft or some bigger bars are available, and people conclude the whole scarcity story is fake. Wrong conclusion. Different products move differently. Some holders dump whatever is easiest to sell when prices spike. Some dealers discount certain inventory to manage cash flow. Meanwhile, wholesale deliverability and consistent replenishment can still be strained, and high-demand products can still carry stubborn premiums. The physical market isn't one pool. It's a patchwork of forms, purity, recognizability, and logistics. Stress reveals the patchwork. Calm hides it. But that's not the part that matters. The part that matters is what physical tightness forces the paper world to do. Think like a risk manager for a second. If you're a dealer or fabricator and your replenishment time gets uncertain, your inventory isn't just inventory, it's exposure. If silver drops $7 overnight, your shelves just lost value. If silver jumps $7 overnight, your shelves are suddenly irreplaceable. So you widen spreads, you raise premiums, you shorten quotes, you reduce size, you push pre-orders, you protect yourself. That behavior alone can keep premiums elevated even if spot pulls back, because your risk is now lead time, not just price. And when premiums stay elevated on pullbacks, it tells you something crucial. The chain is still nervous. The chain is still tight. The chain is still vetoing the paper calm story, because if this one level breaks, the math changes. Now layer in the supply side, because this is where silver is uniquely brutal. Silver supply is stubborn. It doesn't scale neatly with price because a large chunk of mined silver is produced as a byproduct of other metals, copper, lead, zinc, gold operations. That means you can just turn on more silver because the price of silver went up this month. You need mines to expand base metal production. You need projects that take years. You need permitting. You need refining capacity. You need concentrate flow. You need smelter terms. Recycling helps at the margin, and high prices pull scrap out of drawers. But scrap isn't a perfect faucet either. It's lumpy, it's seasonal, it's sensitive to consumer behavior. So when demand surges or when holders decide they want silver as a hedge, the near-term response is almost never supply rises instantly. But the near-term response is price rations. That's the real mechanism, and that's where the real pressure starts. Demand is the other side of the vice, and silver demand is not just investors got excited. Silver lives in industry. Electronics, solar, electrification trends, high reliability applications. Industrial demand doesn't always disappear just because price spikes. Sometimes it pauses, sometimes it substitutes, but often it hedges. Procurement desks don't sit around hoping the spot chart calms down. They manage continuity. They secure supply, they diversify suppliers, they accept higher cost if the alternative is production risk. And when industrial users are hedging or securing supply while investors are also chasing, you get a tug of war that the paper market struggles to represent cleanly. Because paper is designed for liquidity and hedging, not for guaranteeing that a physical chain can smoothly deliver every form of metal at every moment. But that's not the part that matters. The part that matters is institutional flow. You don't need to know every daily number to understand the dynamic. When large pools of capital lean into precious metals during a macro stress moment, currency uncertainty, geopolitical risk, tariff threats, risk-off rotation, silver can become the high beta cousin of gold. Gold moves, silver overreacts. But silver overreacting is not just emotion. It's math. A smaller market, thinner liquidity, more volatility, more leverage, more sensitivity to risk constraints. And when funds move, Market makers hedge. When market makers hedge, the futures curve and options flows can create reflexivity. Price rises, hedging demand rises, which can push price further, which increases margin, which forces the weakest players to adjust. That loop is what people feel as paper lagging, and then suddenly paper catching up all at once. But that's not the part that matters. The part that matters is how fast the loop can flip. That's why I'm hammering the calendar and the margin regime. The CME-S shift toward margins as a percentage of contract value is effectively a volatility accelerant in a fast market. In a slow market, it's a footnote. In a ripping market, it's a pressure plate. If you're short and silver spikes, the collateral you must post rises automatically with the price. That means shorts can get forced to cover not because they're wrong on thesis, but because they're wrong on balance sheet. And forced covering doesn't care about your thesis. Forced covering buys at the worst possible time. That's what squeezes are. Balance sheets, losing arguments with the tape. And if shorts are forced to cover into a market where physical premiums are already elevated, you get a nasty feedback loop. The paper bid rises, physical sellers hesitate, premiums stay sticky, and the spread becomes a louder siren. Because if this one level breaks, the math changes. So what are the proof points? Stacked, not just one story. First proof point, price behavior itself. This month, S moved from the low 70s to above $90 and back into the 80s is not a gentle trend. It's stress behavior. It's the kind of behavior you see when leverage, hedging, and positioning are wrestling, not when a market is calmly repricing. Second proof point, the physical premium behavior. When popular retail forms remain multiple dollars over spot and delivery language becomes cautious, pre-order windows, shifting ship dates, that's the physical chain signaling replacement risk. Third proof point, risk controls. When the exchange changes margin methodology in a way that mechanically increases collateral demands as price rises, you're literally changing participant behavior in real time. Fourth proof point, global safe haven flow narrative showing up across markets, including notable moves in India's futures milestone and broader precious metals, strength amid geopolitical and tariff noise. Fifth proof point, the structural supply constraint, byproduct production and refining lead times, which makes near-term supply inelastic and pushes the burden of adjustment onto price and premiums. That's 5 layers. You can add a sixth, the curve itself and the now versus later tension. Even if you aren't watching every spread tick, you can infer it when the front end acts jumpy and the market treats immediate supply as more valuable than future supply. When a market starts valuing at now disproportionately, it's telling you the tightness is not imaginary, it's temporal, it's urgent. And that's where the real pressure starts. Now let's do the part most hype merchants won't do, counterpoints. Because credibility in a market like this comes from admitting what can go wrong. 1, premiums can be sticky for reasons that don't necessarily imply a massive wholesale squeeze. Fabrication bottlenecks and dealer risk management alone can do it. 2, a sharp price rise can trigger profit-taking and forced deleveraging that temporarily crushes price even if the longer thesis is intact. 3, industrial users can pause or substitute at the margin, reducing near-term demand just enough to cool the panic. 4, macro headlines can fade fast. A tariff threat can be walked back. A geopolitical flare-up can de-escalate, and safe haven bids can evaporate in hours. 5, if the dollar or real yields move hard, silver can get punched in the face even when physical demand is real because paper flows dominate short-term price discovery. These are not bearish narratives. These are the ways volatility humiliates people. And volatility is the tool the market uses to separate conviction from discipline. That's the psychology trap. But that's not the part that matters. What matters is how you keep your brain from getting used against you. In a tape like this, you're going to see headlines designed to flip your emotions. Silver squeeze, followed by silver crash, followed by silver manipulated, followed by silver bubble. The goal isn't to inform you. The goal is to make you reactive. Reactivity creates bad entries, bad exits, and decisions made at the worst time, when spreads are wide and liquidity is thin. So the shield is simple. Separate trend signal from noise. Trend signal is what persists across days and weeks. Premiums staying elevated on pullbacks, risk controls tightening, supply chain constraints, recurring institutional interest. Noise is the intraday whip, the single headline, the 1-hour dump, the one-day spike. If you don't separate those, you'll feel like you're right and still lose money because you'll buy euphoria and sell fear. And that's where the real pressure starts, inside your own decision loop. Now bring it into a clean 2-scenario lens for the next week or two because you need a roadmap, not a vibe. Scenario 1 is the controlled pullback and retest. Silver cools from the high 80s to our low 90s zone back into a support band. Think mid 80s, potentially even the low 80s. Then stabilizes, then retests the breakout area. In that scenario, the tell is premiums. If physical premiums remain stubborn even as the paper price pulls back, it implies underlying tightness and replacement risk are still present. Another tell is behavior around the $90 area. Does price get slapped down instantly, or does it churn and hold? Scenario 2 is the continuation squeeze. Price pushes back toward the psychological $100 handle quickly, not in a neat staircase, but in gaps and air pockets, especially if liquidity is thin and margin dynamics force covering. In that scenario, the tell is speed plus stress. Wider intraday ranges, sharper rallies on bad news, and a market that refuses to stay down even after scary pullbacks. And if silver starts printing near $100 with premiums still elevated, the conversation shifts from retail hype to system stress because the paper market is now repricing under constraint. Because if this one level breaks, the math changes. Let's talk levels, because levels are how you turn narrative into risk management. The $100 handle matters because humans love round numbers and funds love reference points. But psychology isn't the only reason it matters. It's also where a lot of positioning logic gets tested. Sell the number, fade the breakout, take profit into the headline. So expect it to be a battlefield, not a clean pass-through. Under that, the upper 80s to low 90s zone is the real decision zone right now. It's where the market has shown it can accelerate, and it's where it has also shown it can whip violently. If silver holds that zone on pullbacks, it's constructive. If it loses it cleanly and can't reclaim it quickly, then the market is telling you the move is cooling and leverage is being wrung out. Below that, the mid-80s become your are we stabilizing or sliding? A line. A controlled retest that holds mid-80s and builds can be healthy. A fast break that slices through and drags toward the low 80s with premiums collapsing would weaken the tightness narrative near term. Notice what I said, near term. A thesis can be right and still be early, and silver loves punishing early. That's why you need invalidation conditions, not just targets. So here's a grounded way to frame it without pretending you have a crystal ball. If silver reclaims and holds in the high 80s, low 90s, and the physical premiums remain elevated, you have a setup where the market is signaling persistent tightness and the potential for another push toward 100. Not guaranteed, potential. If silver pushes through $100 with speed, the next target zone becomes less about a neat number and more about where liquidity returns, where sellers can actually meet the bid. In a squeeze-like continuation, those zones can overshoot and then mean revert brutally. In a controlled scenario, you may see 100 tagged and then chopped for days while the market decides whether it's real. On the downside, if silver loses the mid-80s and premiums start compressing aggressively, meaning physical starts pricing like replacement risk is easing, then the near-term thesis weakens and the market may need more time to digest. That's your discipline anchor. Because volatility will try to bait you into thinking every candle is destiny. It's not, but that's not the part that matters. The part that matters is what to watch next week. Concrete tells that cut through noise. Watch premium behavior on the most common retail forms. Not because retail sets global price, but because retail is where stress shows up fastest, when fabrication and distribution are tight. Watch for shifting availability language, pre-orders expanding, ship dates slipping, allocation talk. Watch how price behaves around the upper 80s or low 90s zone. Does it snap back after sell-offs, or does it grind lower? Watch the tone of the macro backdrop. Tariff threats, geopolitics, risk-off flows, because silver is acting like a high beta hedge right now, and that can reverse if macro calms. Watch the risk control environment. In a rising market, margin mechanics can create sudden forced behavior, and forced behavior is what creates discontinuous moves. And finally, watch the spread between paper and physical, the real lie detector. If the paper quote dips and the physical spread barely flinches, the chain is telling you tightness persists. If the paper quote dips and the physical spread collapses, the chain is telling you stress is easing. That's the metric people ignore because it's less convenient than a chart. But it's often the more honest signal. Because if this one level breaks, the math changes. Now a quick reality check, because this is where trust is either earned or lost. Silver can whip around violently even if the core thesis is correct. You can be right on direction and wrong on timing, and still get wrecked if you run overexposed or emotionally reactive. That's not fear-mongering. That's how a leveraged, thin market behaves. The tape is designed to punish certainty. The way you stay sane is to treat this as a probability game with scenarios, not a prophecy. And the way you stay solvent is to respect volatility, size appropriately, avoid chasing vertical candles, and decide in advance what would make you change your mind. Not what would make you panic, but what would actually invalidate the mechanism. If premiums compress, availability improves, and the market stops valuing now over later, then the stress narrative cools. If premiums stay stubborn and paper rallies under margin pressure, then the tightness narrative stays alive. That's how you keep the story tethered to signals instead of emotion. One more thing, because this is where viewers get psychologically ambushed. When silver is in a regime like this, you will see two kinds of manipulation, not necessarily malicious, just structural. First is narrative whiplash. The same outlets that ignored the move will suddenly amplify it at the top, right when the risk of a pullback is highest. Second is volatility exploitation. Sharp dips are used to convince you the whole move is over right before the market snaps back. The goal is simple: shake out the undisciplined, reward the patient, transfer money from reactive hands to prepared hands. Your defense is not trying to outsmart every tick. Your defense is watching the right tells and refusing to let a one-day move override a multi-week mechanism. But that's not the part that matters. The part that matters is that this premium up paper lagging story is not a cute anecdote. It's a sign that price discovery is strained. It's a sign that replacement cost is pulling away from screen cost. It's a sign that the market is being forced to reveal where metal is sticky, where liquidity is thin, and where the next forced buyer might come from. And if you want to be early enough to benefit but disciplined enough to survive, you can't just cheer for higher prices. You have to read the plumbing. That's what serious macro watchers and metals people do. They don't just watch price. They watch the incentives, the constraints, the spreads, the calendar, the risk controls. They watch what participants are forced to do. Because in the end, markets move when someone is forced, not when someone is confident. So here's the bottom line for this week. The $100 handle is the billboard, but the real battleground is the zone just below it, where liquidity either refills or disappears. If silver holds the upper 80s or low 90s region on pullbacks and physical premiums stay stubborn, the market is still signaling tightness and the potential for another push. If silver loses the mid-80s and physical premiums compress meaningfully, then the market is cooling and the move may need time to reset. Either way, don't let the noise steal the lesson. When physical pricing refuses to follow paper down, the chain is telling you the stress isn't T just in people S heads, it S in availability, lead times, and risk management. And if the exchange's margin math continues to ratchet with price, the weakest balance sheets will eventually be forced to make a decision. That's where the real pressure starts. If you're the kind of person who wants the clean, mainstream story, this market will frustrate you. If you're the kind of person who wants the mechanism and the tells, this market is handing you a playbook in real time. Stay disciplined, watch the spread, respect volatility, and don't let a single candle hypnotize you into forgetting the bigger setup. And if you want more of this style of breakdown, less cheerleading, more plumbing, more what to watch next, like a real desk, stick with this community because the advantage isn't having stronger opinions. It's having cleaner process when the tape gets loud.